Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning. Happy Friday. Welcome to your U.S. Market Update. I'm Emaad Akhtar. Let's take a look at what happened in the markets stateside on Thursday. The S&P 500 fell, spurred by a drop in shares of EV maker Tesla. The broad market index dipped 0.5% and closed at 5,939, while the Nasdaq Composite pulled back 0.8% to end at 19,298. The Dow Jones Industrial Average, meanwhile, dropped 108 points to settle at 42,320. Tesla, as I mentioned, was a big laggard in the session, down more than 14%. I think they're sliding even more than that right now and losing its trillion-dollar market cap status. Shares of the company slid after President Donald Trump said he was, quote, very disappointed in CEO Elon Musk. Musk shot back at the president, saying in a post on X that, quote, without me, Trump would have lost the election. Shots fired. Shares of Circle Internet Group, meanwhile, soared 200% after the stablecoin company and its selling shareholders raised almost $1.1 billion in an IPO. The stock opened at $69.50 on the New York Stock Exchange after its IPO priced at $31. At one point, it surged as high as $103. All right, to talk more about what's happening in the markets, we have on the line Chris Weston, who's the head of research at Pepperstone. Good morning, Chris.
Good morning. How are you?
Good. How are you?
Going well. Not too bad. It's been a pretty lively day, pretty lively session in the US. So expecting some of that to spill out now into Asia when they open. Yeah,
absolutely. I'm sure you're as surprised as I am about Tesla's rapid decline in stock price. 14%. I think if I was seeing an intraday trading right now, down 16%, dropping Tesla $152 billion in value, the biggest hit to its market cap ever, putting it below the $1 trillion benchmark and settling Thursday at $916 billion. What happened there?
Well, I mean, I think if you've got shareholders of Tesla, obviously they're just still getting over the brand damage that was taking place from Musk being in the administration. Obviously, they're very pointy rhetoric at a lot of sort of foreign sales destinations, and obviously we've seen sales collapsing in certain jurisdictions. So there was already that situation, and then he pulled away from Doge. And now we're seeing another situation, of course, where he's taking on the president, and obviously there's a massive revenge hit that's been taking place. And some of the comments last night were pretty pointy. I won't, you can go and have a look on his post on X, sort of regarding Epstein's list and stuff like that. But it's starting to get a bit more personal now, and you sort of take on the president, and that has obviously implications in terms of the brand and how that's going to go. Obviously, they're going to take a hit potentially further down the line when the big beautiful bill goes through, when it finally does go through the Senate. But so they're going to take an earnings hit to that. But now you take on the president, and that really doesn't do shareholders any favours either. So obviously the stock down very hard. But we're seeing it come back in the after hours trade now. It's up a little bit. So it was down, and there are a few people probably seeing that as a little bit overdone. But 285 million shares traded on hands. It was a big sort of sell first, ask questions, and the options market came alive. We saw 4 times the usual amount of puts that we'd be seeing. So obviously people speculating there could be more to go.
Yeah, I wonder if this is an indication of the trajectory of U.S. equities moving forward. What on that front are some of the risks that we're currently facing, and what do you like? Where to from here?
Well, we've liked the hard data. A lot of the soft surveys have been very fickle and sort of reacting to what we've seen in tariffs, and they got taken down when we saw Liberation Day, and then obviously they've come back a little bit some of the survey-based measures since the 90-day pause. But the hard data, things like the unemployment rate and various factors, have been very supportive, and the businesses haven't really retrenched. But obviously that comes into question now because we've seen the jobless claims numbers last night moving up. The continuing claims have been pushing higher. Jobs hard to get versus abundant have been a little bit more concerning. But obviously the payrolls number in the session ahead, if that was to be an outlier print and, perhaps go in the same sort of way that the ADP payrolls number went earlier in the week, then, I think that's really, really a huge part of the sentiment game that we've been seeing. So as long as the unemployment rate was to stay at 4.2%, I think you could probably see a little bit of risk come back in the market because it is so integral to where we are here in terms of the cyclical versus defensive nature of the market at the moment. So I think that's a big one. Obviously, we're going into the Senate debate around the big, beautiful fiscal bill that we've been seeing, and there's going to be a headline fest around that, because there's I think like 112 different provisions involved in that, and in terms of the passing of that, it's going to be far less smooth than what we saw going through the House. And of course, Trump is now even more riled up to get this through, because the way that Elon Musk has been sort of taking this to him. So I think he's going to be really trying to corral senators to get this through. But I don't think it's going to be particularly smooth, and there's going to be a lot of headline risk around that. But I think really it comes down to the data, and also as we go into 9th of July, what happens with, the 90-day pause on tariffs. Again, that could be something that we do need to look at. But, obviously we're coming into US summer, and the propensity for potentially lower volatility is there. But, it's all about politics here, and it's all about fiscal, I think, and, the smooth passage of that passing.
Yeah, I read somewhere, I think it was on the New York Times, a nice headline, big ugly battle over the big beautiful bill. And it seems so, especially with Elon Musk calling the tax bill a disgusting abomination. Speaking of data, Chris, on the economy front, we get non-farm payrolls out later today in the US, and these are going to be key. We had ADP employment data earlier in the week showing that only 37,000 jobs were added in the US private sector in May, which was the lowest since March 2023. And the ISM Services PMI also fell to below 50, which marked the first time it has entered contraction territory since June last year. So how will the market react to potential outcomes of the non-farm payrolls?
Yes, it's so integral to why we are here at the moment, the fact that the labour market hasn't really cracked in terms of the payrolls number. And that's been, people are saying, well, when will we start seeing this radical cooling of payrolls at a time when labour market supply is probably going to dissipate under the immigration changes? Yeah, I think if you look at the options market, they're not expecting big moves from payrolls number. We really find it very hard to pre-position for them, because so many of the leading indicators we get, such as the ADP, such as claims and all these other factors, have been so poor in predicting where the non-farm payrolls number outcome comes over the last 12 months, that you can't use any of these inputs to sort of guide where the market, where we need to position portfolios going into the non-farm payrolls number. What we have seen has been a propensity, if we are going to get an outlier print relative to the consensus, it has been to the upside. We've been more attuned to seeing big beats rather than big misses. But could this be the time when the ADP number, which you say was weak, actually proves to be a decent guide? We'll have to see. That's something we need to be open-minded to. But I think, if we were to see the unemployment rate at 4.2%, perhaps 4.1%, a few jobs coming into the household survey, then the risk market would rally, because it puts off, again, the idea of recession anytime soon. But I think, I think the risk for markets is if we were to get something below 80,000 on the payrolls, market's looking for 126,000, below 80, below 70,000, that would mark a decent cooling relative to the 3-6 month average. And I think an unemployment rate, above 4.3, 4.4%, and I think the market would be a little bit concerned and maybe de-risk. That's where we'd probably see some volatility. Yeah,
so there's been a weakening of both employment and services data, and also a lot of talk of continued downside risks to the US dollar. According to the US dollar index, the greenback has lost almost 9% since the start of the year. That's its worst performance over the first 5 months of the year for almost 2 decades. Where do you sit on that call?
Well, I think very, very short term, I think people obviously are looking at the US dollar and position short and expecting it to go down. I don't think the US dollar is a particularly short position. Looking at big picture it's more of an over-discussed topic rather than actually something that's over-positioned for, because while we're talking about sort of speculative positions being short, the big picture is that companies and entities over the last 30 years have a massive amount of US dollar holdings. This idea of US exceptionalism, there is no alternative, has seen huge amounts of capital parked into US equities, US treasuries and US assets, private equity and all those factors relative to any other market. And that's still there. And so whilst we're not in the camp that we're going to see the end of the US reserve currency status anytime soon, if at all, we do sit in the camp that over time, a lot of this capital will be needed to be hedged and removed out in terms of removing their dollar holdings. So I don't think anyone's giving up on US equities. It's still, there's no other market like it. But I think people are looking at their US dollar exposure and neutralising it back into Korean won, into Japanese yen, some of these Asian surplus currencies, Chinese renminbi to an extent, euros, and I think that's got further to go. So I do sit in the camp in the next 12 months. The dollar will be weaker against all currencies really, and we're going to see it mean revert to sort of purchasing power parity. So I do sit in the camp that over time, the dollar's got another maybe 10% downside.
Yeah, maybe the EM carry trade will also gather some steam. It remains to be seen, I suppose. Speaking of hedging, gold, given all we've talked about above, where do you stand on gold? We're almost running out of time, so maybe a quick 30 seconds on this one.
Last week, it's just really been inverted to the US dollar. So really, when it comes to payrolls tonight, we've got to take the view that we'll see what happens with payrolls. If we get a good one and strong one and the dollar rallies, then gold's probably got some downside. But the Chinese, everything seems to be coming in when China comes in at 11 a.m. Eastern Standard Time, and China continues to be buying all pullbacks at the moment. But I think, the bulls really want to see 3,400 broken. We tested that last night and the sellers came in. So that's the key level that we need to break.
All right, Chris, it's been a pleasure having you on the show. Thank you so much for your time and insights as always.
Pleasure. Thanks for having me on.
Cheers. Have a good one. That was Chris Weston, Head of Research at Pepperstone. Stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.